Just after midnight in New York, the chart looks almost peaceful. Silver has been climbing for months, grinding higher through every dip, shrugging off every attempt to push it down. The story is everywhere now. Inflation is back. Currencies are being debased, and silver, the poor man's gold, is finally waking up. Social media is full of targets. $50 is a given. $100 is the real prize, the line in the sand that would prove the system is breaking. On trading screens from Singapore to Zurich, the candles flicker green. Liquidity is thin, as it always is at this hour, but the trend looks unstoppable. Then, out of nowhere, a single red candle appears that shouldn't exist. The candle slices straight through the order book. In seconds, the price drops 50 cents, then $1, then more. There is no news, no economic release, no surprise interest rate decision, no geopolitical shock. Just a wall of selling that hits an almost empty market. Retail traders stare in confusion as their stops are triggered one by one. Messages flood the chat rooms. What just happened? Who dumped that? Here comes another midnight raid. To understand what is really going on in a moment like this, you have to start with how silver is actually priced. The global silver price everyone watches is not set in a quaint physical market where miners meet jewelers and industrial buyers. It is set, overwhelmingly, in a world of derivatives. Futures contracts on exchanges like COMEX in New York and an enormous opaque over-the-counter market centered in London. For every ounce of physical silver that moves from a refinery to a mint or electronics factory, hundreds of ounces trade as paper claims. Contracts that promise delivery someday, but almost never end in it. A futures contract is a promise between a buyer and a seller to transact a given amount of silver at a future date for a price agreed today. Because these contracts are margined, you don't have to put up the full notional value. With 10-1 leverage, you control $100,000 worth of silver with $10,000 of capital. That leverage cuts both ways. A 5% move against you can wipe out half your equity. That is the seedbed of both fortunes and forced liquidations. Now add time of day to this leverage, around midnight. New York time, US traders are mostly gone. European traders are only beginning to stir. Asian markets are active, but not fully focused on COMEX silver. The deepest liquidity tends to appear during overlapping European and US hours. At that thinly traded moment, the order book can be surprisingly fragile. A sufficiently large sell order, or a carefully timed series of them, can punch right through the bids, triggering the next layer of selling. Stop-loss orders placed just below recent lows, risk limits at funds, automated trading signals that flip from buy the dip to get out now. In precious metal circles, this pattern of abrupt, newsless sell-offs during illiquid hours has become infamous. Traders have come to call them midnight raids. The phrase suggests intent. Someone, somewhere, wants the price lower and chooses the time when the market is weakest to make it happen. Whether that is a fully coordinated secret plan or simply rational, aggressive trading by large players, taking advantage of structure is the key question. But the fact of the pattern itself is not imaginary. If you scroll through intraday charts over the last decade, you will see a recurring motif: sudden vertical red lines crashing through otherwise calm price action, often clustered around off-peak trading times. The stakes around silver's price are not just technical. Silver has a double identity. It is an industrial metal critical for electronics, solar panels, and medical devices. And it is also a monetary metal tied to centuries of history as coinage and a store of value. When inflation fears rise, or confidence in fiat currencies erodes, silver becomes both a trade and a symbol. A move from $20 to $30 signals a strong bull market. Above $50, which marked the blow-off highs in 1980 and again briefly in 2011, you are in historic territory. Above $100, you are in a world that markets have never seen in nominal terms. A world that many believe would shout that something is badly wrong with paper money itself. That is why the idea of a midnight raid is so emotionally charged. It is not just a move against a commodity. It is perceived as a move against a narrative, against a thesis that silver should be much higher, maybe dramatically higher, if not for repeated interventions. The price action in the dead of night looks like a hand on the scale. Behind the flashing candles is a deeper financial question. Who benefits if silver never reaches $100? And how exactly could they stop it from getting there, even in a world of massive retail flows and growing physical demand? To begin to answer that, you have to look behind the retail screens and into the positioning of the large players who dominate the futures market. On one side are speculators in CFTC language, hedge funds, commodity trading advisors, momentum-driven funds, and increasingly an army of algorithmic systems reacting to price moves in microseconds. On the other side are commercials, mining companies hedging production, refiners, industrial users locking in costs, and critically, the bullion banks and dealers who make markets in silver for everyone else. The commercials often carry large short positions, hedging or otherwise, while the speculators often lean long in bull markets. That asymmetry is not a conspiracy by itself. It is how hedging works. But it can create tinder for violent moves if those shorts are ever forced to cover in a true squeeze. And a sprint toward $100 would be the mother of all squeezes. For now, though, it is still midnight. The raid is unfolding. The price is dropping fast, taking out level after level where leveraged longs were hiding. Margin calls are being calculated automatically. Somewhere, in a glass tower where the lights never truly go out, a risk manager watches the position dashboard and nods. The market, at least tonight, is going exactly where someone wanted it to go. Whether that someone is defending a huge short book, hunting for liquidity, or simply front-running predictable stop-loss clusters, is the line between a sinister secret plan and brutally efficient market microstructure. To understand the anatomy of a midnight raid, imagine sitting on the desk of a large bullion bank or multi-strategy hedge fund. You are running a substantial short book in silver futures, partly as a hedge for client flows, partly as a directional bet. Your models tell you that speculative longs have piled into the market in recent weeks, chasing momentum as silver broke above a key resistance level. The CFTC Commitments of Traders report shows managed money net long at the highest level in months. Social media buzz confirms what the data suggests. Retail is all in, and many of them are doing it with leverage through margin accounts, CFDs, or options. From a purely financial perspective, a long, crowded, leveraged market is vulnerable. If you can trigger a reversal sharp enough to flip technical signals and hit leveraged players' pain thresholds, the selling will feed on itself. The question is not just whether you can push the price lower, but how much fuel is stored above and below current levels in the form of resting orders and stop losses. Experienced traders develop an almost intuitive sense of where these clusters lie, just below recent lows, below round numbers, below obvious support lines drawn on every speculator's chart. The midnight hour offers a strategic advantage. In liquid hours, when New York and London are both fully awake, the order book is thick. There are bids and offers on every tick, and the size at each level is enough that moving the market decisively requires enormous firepower. But when volumes dry up overnight, the same notional volume can have a far greater impact. If you unload, say, 5,000 contracts of silver futures during a sleepy Asia session, you are not simply selling to meet natural demand. You are, in effect, hitting every visible bid and forcing the price down to find the next pockets of liquidity. This is where leverage and margin come into play. Futures markets use variation margin. Positions are marked to market daily, and losses must be covered in cash. If the price moves sharply against a leveraged long, the exchange or broker will issue a margin call. If the trader cannot post more collateral quickly enough, the position is liquidated, converted into a market order that sells into the already falling price. That forced selling is not optional. It is automatic, mechanical, indifferent to fundamentals. It is the perfect accomplice to an aggressive seller who started the avalanche. Add to this the role of algorithms and high-frequency traders. Many modern trading systems watch for breaks of support levels, surges in volume, and sudden price accelerations. When a midnight raid begins, these systems may register the move as a trend shift, flipping from net buyers to net sellers in milliseconds. Liquidity that appeared to be available on the bid suddenly vanishes as algorithms pull their resting orders to avoid being run over. This liquidity gap can turn what might have been a $1 move in a normal session into a $3 or $4 plunge in an illiquid one. From the perspective of the initiator of the raid, the beauty of the strategy lies in the asymmetry between effort and result. By concentrating selling pressure into a thin period, you maximize the price impact per contract sold. As the cascade of stops and margin calls adds more selling, your initial position benefits. If you were short silver going into the move, you can start to cover at much lower prices, buying back the contracts you sold earlier at a profit. In extreme cases, if the panic is deep enough, you might even flip long, positioning yourself for the eventual rebound when the forced liquidation exhausts itself. None of this requires a formal secret meeting in a smoke-filled room. It requires large capital, a deep understanding of market microstructure, and a willingness to act aggressively when conditions are favorable. That is why regulators face a difficult line. On one side is legitimate aggressive trading, using size and timing to your advantage in a legal marketplace. On the other side is manipulation, trading with the intent to create an artificial price, often involving spoofing, placing orders you intend to cancel, or collusion between firms. There are documented cases where that line has been crossed. In 2020, JP Morgan Chase agreed to pay $920 million to settle charges by the U.S. Department of Justice and the CFTC that its traders engaged in years of spoofing in precious metals and treasury markets. Traders placed large orders they never intended to execute to create false impressions of demand or supply, then profited from the resulting artificial price changes. Chat logs showed clear intent to spoof, leaving little room to argue this was normal trading. That settlement was a rare window into how aggressively some desks were willing to push. Yet, even with those facts, most midnight raids are never proven as manipulative in court. A single large sell order at a thin time is not illegal by itself. A bank hedging a client exposure or a fund liquidating a losing position might produce a similar pattern without any desire to manipulate, proving intent that the goal was to create a misleading price rather than to genuinely execute is the regulator's hardest task. And markets, especially in commodities, have always had dominant players who could move prices simply by virtue of their size. This is where the story bleeds into suspense and speculation. Many silver investors are convinced these raids are not random, that a group of large players has both the incentive and the coordination to keep the price below dangerous levels. They point to the repetitiveness of the pattern, the way big sell-offs often align with key technical breakouts, the persistent large short positions held by a handful of institutions in CFTC data. Others counter that in every leveraged market, similar dynamics appear. When a trade is crowded, sharp reversals are common and thin hours amplify them. Regardless of which camp you lean toward, the mechanics are the same. A midnight raid is ultimately a story about liquidity, leverage, and human and algorithmic behavior under stress. When the first red candle appears, nobody knows for sure whether it's a forced liquidation, a deliberate hunt for stops, or the opening move of a bigger campaign. All anyone sees is the price. But behind that glowing number are balance sheets, risk models, and some very real financial pain, especially if the stakes involve not just a few speculative bets, but billions of dollars worth of short positions that would be annihilated if silver ever truly broke free and raced toward 100. Why might someone care so much about keeping silver below $100? To answer that, think like an institution, not an individual trader. Start with the simple math of a short position. Suppose a major dealer or bank, let S call it a composite bullion bank, has effectively sold short 200 million ounces of silver through futures, forwards, and unallocated accounts. If silver is at $25, the notional exposure is $5 billion. If the price doubles to $50, that short is $5 billion underwater on paper. If it triples to $75, the loss is $10 billion. At $100, it is $15 billion in heavily margined markets. Those losses are not abstract. They require cash. As the price rises, the short must post more collateral daily. If the exposure is hedged one-for-one by physical metal or by offsetting long positions elsewhere, the net risk is limited. But in practice, exposures are complex and imperfectly hedged. Some short positions represent obligations to deliver metal someday that may or may not be fully backed by inventory. Some represent client trades that behave differently under stress than expected. In a slowly rising market, this can be managed. In a runaway squeeze, the capital drain can be catastrophic. Now layer on the psychological and symbolic power of the $100 level. Markets are deeply influenced by round numbers. They are natural focal points for options, strikes, for technical targets, for media narratives. A silver price with 2 digits and no comma is still, in some sense, in the world we know. A silver price with 3 digits screams regime change. In inflation-adjusted terms, silver's 1980 high near $50 already represented extraordinary stress in the monetary system. Repeated in modern dollars, that spike would be well above $100. Many hard money advocates and silver enthusiasts argue that a $100 silver price would be interpreted by the public as a sign of terminal fiat weakness. That if an obscure industrial metal tied to old coinage traditions can triple or quadruple in price, something is deeply wrong with the dollar, the euro, the yen. Whether that interpretation is strictly logical is another matter. What matters is that markets and politics are sensitive to symbols. When gold hit $1,000 for the first time, then $2,000, the headlines wrote themselves. Silver at $100 would trigger a similar wave of commentary, amplified in a social media era. The argument underlying the secret plan thesis is straightforward. If large financial institutions, and by extension, central banks, have an interest in preserving confidence in fiat currencies and in the stability of the financial system, and if a silver price explosion threatens both by exposing massive short positions and shaking public faith, then those institutions have a motive to prevent that explosion. The alleged method is not overt price controls, but rather persistent tactical interventions in the paper markets, especially at moments when silver threatens to break out of its historical range. Midnight raids, in this view, are not isolated events, but moves on a long-running chessboard. Critically, direct evidence of such a coordinated systemic suppression program is scant and highly contested. There is strong evidence of episodic manipulation, like the J.P. Morgan spoofing case, and of concentrated short positions held by a few players. There is circumstantial evidence in the recurring patterns of sharp sell-offs at key technical points. But there's no smoking gun memo from a central bank ordering the banks to keep silver under 100, no leaked document mapping out a formal plan. That gap between motive and proof is where suspense lives. In online forums and certain corners of financial media, you will find elaborate reconstructions of who might be involved, how they communicate, what their positions might look like. Some of these narratives stray into full-blown conspiracy theory, attributing near omniscient control to a small cabal. Others are more modest, suggesting that you don't need a centrally directed plot. You just need a handful of large institutions with similar risk exposures, all responding in roughly the same way when prices rise too far, too fast. From a purely financial standpoint, you can imagine a scenario where no one ever says, "We must keep silver below $100, yet everyone behaves as if they had. Risk officers see VAR models flashing red as silver climbs. Margin requirements increase. Hedging desks get instructions to reduce exposure. Traders, aware of thin liquidity at night, choose those hours to make their adjustments, dumping futures when the market is weakest to get the most bang per contract. Independently rational decisions by multiple players can create actions that look coordinated from the outside. Still, the numbers are sobering. The global silver market is relatively small compared to gold or major currencies. Annual mine production is around 1 billion ounces. Above-ground stocks are limited, and a meaningful portion is locked into industrial use. Yet the notional volume of silver trading on paper, futures, options, OTC forwards, can be dozens of times that physical flow. That leverage means the fortunes of a few large players can be deeply affected by relatively modest price moves, especially if they are on the wrong side of the curve. At $30 or $40, losses on a bad short book can be absorbed, disguised, managed. At $100, holdings that were assumed to be safe hedges or temporary positions become existential threats. And it's not just the direct short positions. Silver serves as collateral in some financing arrangements. Its price affects the balance sheets of mining companies and refiners, which in turn affect their banks. A parabolic spike can force desperate, correlated actions across an ecosystem. For risk managers in large institutions, that is a scenario to be feared and, if possible, preempted. So imagine the mood in a risk committee if silver begins to accelerate. Headlines about shortages in the physical market pick up. ETFs like SLV are seeing record inflows. Retail demand for coins and bars empties dealer shelves. Premium spike. Technical analysts talk openly about a break to new all-time highs and blue sky beyond 50. At 60, you are in uncharted territory. At $80, the old constraints and models start to feel irrelevant. The question on everyone's mind becomes, what happens if this doesn't stop? In that context, a midnight raid is not just a cynical trade. It can look, inside some institutions, like a kind of emergency pressure release valve. Knock the price back down, flip the charts from bullish to ambiguous, scare off momentum traders, and you might buy months or years of breathing room. Let the move run unchecked, and the losses could go from painful to unmanageable. Whether you see that as prudent risk control or as manipulation depends largely on your prior beliefs and on whether you prefer the one on the other side of the trade when that red candle appears. Any claim about a secret plan has to be measured against history. Silver has a long record of both manic booms and brutal busts, often involving outsized players. The most famous example is the Hunt brothers saga of the late 1970s. Nelson Bunker Hunt and his brother William, Texas oil heirs, accumulated huge physical silver positions and futures contracts, trying to corner the market. At one point, they controlled or had claims on roughly 1/3 of the world's non-government silver supply. Prices soared from around $6 an ounce in early 1979 to nearly $50 by January 1980. The response from the financial system was swift and decisive. The COMEX exchange changed its rules, raising margin requirements, and eventually limiting trading in silver to liquidation only. That forced longs to sell, collapsing the price. On Silver Thursday, March 27, 1980, silver plunged, and the Hunts were effectively destroyed financially. To some, this episode is a template. When silver threatens to break the system, the rules change to protect the system. Yet the Hunts were undeniably trying to manipulate the market themselves. The exchange S actions can also be seen as protecting other participants from a corner that had become systemically dangerous. Fast forward to 2011. In the aftermath of the global financial crisis, with central banks flooding markets with liquidity, silver embarked on another parabolic run. From under $10 in late 2008, it surged toward $50 by April 2011. Investor fear of inflation, distrust of banks, and a surge in ETF demand combined with strong industrial use and tightness in some physical channels. Once again, as silver approached its old 1980 highs, the moves became increasingly violent. Retail dealers reported shortages of coins and bars. Websites and newsletters trumpeted a coming silver shortage and spoke openly of 3-digit price targets. Then, in late April and early May 2011, the market snapped. Over a matter of days, silver crashed from near $50 to below $35 and then lower. A key feature of that episode was a series of rapid increases in margin requirements on COMEX silver futures. The CME Group, which owns COMEX, hiked margins multiple times in quick succession, raising the cost of holding leveraged long positions. This forced many speculative longs to reduce positions or exit entirely. The resulting selling pressure cascaded, wiping out much of the explosive gains. Critics argue that these hikes were timed and structured in a way that disproportionately hurt small speculators, and that they effectively popped the silver bubble just as it threatened to break decisively above prior highs. Defenders respond that volatility was extreme, that risk controls demanded higher margins, and that similar hikes occur in other commodities under stress. Once again, the same event can be read as either a necessary safety measure or as part of an implicit bias toward capping silver AUS ascent. Overlaying these episodes are the more recent legal cases. The J.P. Morgan spoofing settlement in 2020, which covered conduct from roughly 2008 to 2016, revealed chat messages in which traders joked about manipulating metals, markets coordinated placing and canceling of large orders, and explicit intent to mislead other participants about supply and demand. The Department of Justice described it as a massive multi-year scheme. Several individual traders were criminally convicted. These were not late-night theories in internet forums. They were findings in court. At the same time, it is crucial to distinguish between the kind of manipulation documented in those cases, spoofing and abusive order placement to nudge prices around intraday, and the grander claim that a coordinated, enduring campaign exists to suppress silver over decades. Spoofing can move the price a few cents or dollars in short bursts, especially in thin markets. It can help trigger or reinforce a raid. But sustaining a suppression of a commodity price over many years in the face of genuine demand, supply constraints, and global investment flows is a far taller order. History shows that despite any attempts to manage or influence it, silver can and does explode when conditions align. The 1980 and 2011 spikes are proof that the system is not omnipotent. Those spikes were followed by long bear markets, which suppression theorists sometimes attribute to renewed, more subtle pressure. But they can also be explained by the classic pattern of commodity cycles. High prices incentivize increased production and conservation, while speculative money exits once the parabolic phase ends, leaving an air pocket beneath. Still, the structure of the silver market undeniably lends itself to control by a relatively small number of players. The London over-the-counter market is opaque, with bilateral deals between bullion banks and institutions that are not reported in real time. Much of this business is done in unallocated accounts, where clients are creditors of the bank rather than owners of specific bars. The daily price benchmarks, formerly fixings, in London and futures settlement prices in New York are both influenced heavily by the flows of a handful of large dealers. Because the paper market dwarfs the physical one, large positions in derivatives can steer the visible price even if only small amounts of metal change hands. In such an environment, if a concentrated group of institutions decided that silver at $80 or $90 posed unacceptable risks, they would not need a formal conspiracy to act. Each would see, from its own books, that higher prices meant larger collateral calls and more fragile counterparties. Each would have the tools to trade aggressively when needed. Each would have a vested interest in keeping volatility within tolerable bounds. From the outside, their collective behavior might easily look like a coordinated defense. Investors watching this history unfold feel a tension between two truths. On one hand, there is ample evidence that metals markets, including silver, have been abused by some major participants, that regulations lag innovation, and that thin, leveraged markets are susceptible to sharp, unnatural moves. On the other hand, silver has repeatedly broken free of its chains when underlying fundamentals and speculative frenzy lined up. No amount of midnight raids could keep it below $50 in early 1980 or spring 2011, at least for a time. That is what makes the question of $100 so charged. The market has seen $50 twice. It has never seen $100. If silver were to chew through the supply of willing sellers, shrug off raids, and margin hikes, and establish itself convincingly in three-digit territory, it would not just be another strong rally. It would be a regime shift, one that many believe the current monetary and financial architecture cannot easily absorb. Whether that belief is right or wrong, the fear of testing it may itself be enough to motivate powerful actions in the dark hours before dawn. Strip away the drama, and what remains is a market whose short-term action can be shaped by large players and whose long-term trajectory is still governed by fundamentals and capital flows. For an individual trying to make sense of stories about midnight raids and secret plans, the distinction matters. You do not need to believe in an omnipotent cabal to recognize that silver trades in a framework that is hostile to small, leveraged speculators and favorable to deep-pocketed institutions with superior information and execution. In practice, this means that sudden newsless plunges at thin hours are not anomalies. They are features of a leveraged, order-driven market. When you combine high leverage, clustered stop-loss orders, algorithmic trend followers, and the uneven distribution of liquidity across time zones, the conditions for raids are present even if no one is deliberately trying to suppress silver forever. A big player liquidating a position, a hedge adjustment, or a cynical stop hunt can all produce the same terrifying red candle on your chart. At the same time, documented cases like the JP Morgan spoofing scandal and the 2011 margin hikes show that institutions do sometimes act in ways that can dramatically skew the playing field. The legal line between aggressive trading and manipulation is drawn narrowly. Much behavior that feels unfair to smaller participants remains permissible. Knowing this, individual investors have to calibrate their expectations. Silver is not a clean, transparent playground where true price is discovered serenely. It is a battleground where price can deviate from what fundamentals might suggest for extended periods, particularly on short time frames. So, is there a secret plan to crash silver before $100? If by plan you mean a formally documented, centrally coordinated scheme signed off by central banks and global banks in collusion, there is no public evidence for such a thing. Regulatory investigations and court cases have unearthed serious misconduct, but nothing that rises to the level of a single, unified program to cap silver at a particular number. Calling that scenario established fact would overstep what the available data supports. If instead you mean that there are strong structural incentives for some large players to prevent uncontrolled spikes in silver, that off-peak raids are a rational tool to manage risk or profit from crowded positioning, and that the combined effect of these behaviors is to keep silver Ixis rallies more muted than they might otherwise be, then the story becomes more plausible. It becomes less about a grand conspiracy and more about path dependence, the way the architecture of the market, the concentration of capital, and the psychology of institutions work together to shape outcomes. For a thoughtful investor, the implication is not necessarily to flee the market, but to change the way you participate. If you believe silver is fundamentally undervalued and that, over years, monetary and industrial forces will push it higher, you can express that view through low or no leverage positions. Physical metal in your possession, fully paid shares of reputable ETFs, or stakes in miners you have analyzed properly. These positions can ride out midnight raids without forced liquidation because their survival does not depend on daily price marks. Conversely, if you choose to speculate in futures, options, or leveraged products, you are stepping onto the battlefield where midnight raids and stop hunts are part of the terrain. That does not make profit impossible, but it makes risk management paramount. Placing obvious stops just below textbook support levels, over-leveraging, or trading on short-term patterns without understanding how quickly liquidity can vanish leaves you vulnerable to the very dynamics that give rise to the raid narrative. There's also a subtler lesson in the $100 obsession itself. Round numbers fascinate markets, but they can distract from more important questions. Whether silver trades at $92 or $108 in some future crisis matters less than whether the underlying reasons for that move, inflation, currency instability, supply shortfalls, surging industrial demand, are ones you have prepared for. Focusing exclusively on a magic target can lead to poor decisions, refusing to take profit because the real move starts at $100, and we're panicking out of a sound long-term thesis because a midnight raid knocked the price from $48 to $40. In the end, the midnight raid is both real and metaphor. Real in the sense that large strategic sell programs in thin markets have happened and will happen again. Metaphor in that it stands for the broader asymmetry between the individual and the system. On one side of the screen are retail traders watching a line jerk up and down, reading narratives about suppression or liberation. On the other side are institutions watching risk dashboards, margin reports, and aggregate positioning, acting to defend their own balance sheets in the most efficient way available to them. Some nights, their interests and the market's short-term direction align, and the price falls hard. Other times, regardless of how many raids are launched, underlying forces win and silver grinds higher, forming a series of higher lows and higher highs that slowly erode even the most determined defense. Whether silver ever prints $100 will ultimately depend less on any one raid and more on the slow accumulation of imbalances, years of underinvestment in mining. The pace of solar and electronics demand the trajectory of real interest rates, the credibility of central banks. If that day comes, if the ask on your screen finally shows a 3-digit number, it will not mean there was never any attempt to stop it. It will mean that the combined weight of fundamentals and capital flows has overwhelmed the tools available to those who preferred otherwise. Between now and then, the raids in the midnight hours will remain what they have always been. Sharp reminders that markets are not fair, not gentle, and not obligated to move in straight lines even when the long arc of value points higher.